All right, good afternoon, everyone. Thank you for joining us so much on behalf of the National Renewable Energy Laboratory and Defenders of Wildlife. Really grateful that you've stuck with us through the 8th webinar in our series on wind energy and wildlife interaction. For those of you who don't know me, I'm Pasha Feinberg. I'm an analyst at Defenders of Wildlife, and I'm one of the co-creators of this series. And I have the honor of moderating today's webinar, which is on the economics of wind energy and how that relates to implementing wildlife minimization. And I think that wind energy economics are really a black box for many of us. They certainly are for me. So I'm really excited to find out more about this, and I hope you all are as well. So before we launch in, I'm going to cover some housekeeping notes for those of you who haven't joined us on previous webinars. The audience is going to be muted throughout this webinar series, and if you have any issues with the audio, I recommend that you first try navigating to the audio tab, which is on the right-hand side of your screen, and then calling in through your phone. And if you have any persistent audio issues, then try using that support page that's linked on this site, on this slide, excuse me. So we are really, really excited for our expert speakers who are joining us today, and I ask that as you listen to their presentations that you assume positive intent. We're all working with really complicated issues, and the various perspectives that we're hearing from are really important. Please put any questions that you have in the Q&A box, which is also on the right-hand side of your screen. If there's time, we're going to give our speakers a chance to respond to you at the end of this webinar. And if there's not, we'll follow up with something written. And we are really going to try hard to define all of the terms and the acronyms that we use. It's definitely quite possible that some will slip through the cracks. So if you have any that you want clarified, if you also ask that in the Q&A box, we'll try to get that back. We'll try to get those defined for you in real time. As always, if you're looking for more information on wind energy and wildlife, then I highly recommend that you check out Tethys. It is an incredible resource. And this entire webinar series, including this webinar, are going to be recorded and posted on there. So as I mentioned before, this is the 8th webinar in a 9-part series, which means that there is still one more webinar, and we are hammering out the final details on that. So keep your eyes peeled for information. If you signed up to the Google form for information on this series, you're going to get an email. And we also plan to send out some updates through Tethys Blast and the National Wind Coordinating Council's newsletter. So I'm keeping this introduction really brief because I want to give as much time as possible to our 4 speakers who are being super generous in sharing their time and their knowledge with us for this webinar. So it's my pleasure to introduce Connor Kubeski. He's the International Renewable Energy Development Engineer at Invenergy LLC. We have Natalie McHugh, Senior Director of Environmental and Permitting at Pattern Energy. Sergio Roldan, who's the Project Manager in Mergers and Acquisitions at DNVGL. And Taylor Parsons, who's the Wind Energy Analysis Team Leader at DNVGL. Thank you all, 4 of you, for joining us. Connor's going to get us started, and he's going to be followed by Natalie, Taylor, Sergio, and then we're going to go back to Natalie, who's going to conclude with some broader industry perspective. So with that, I am going to hand it off to Connor, and Connor, you will get a prompt imminently that you'll be able to share your screen.
Okay, hi everyone. As Pasha said, I'm Connor Kubeski, and I'm a project engineer with Invenergy. And for those of you that don't know Invenergy, we are a utility scale developer of renewable energy projects, predominantly wind and solar. It also includes battery storage and gas thermal as well. So let me bring up the presentation. Okay, so
That's okay, great.
So great. First off, I figured a good way to get this started would be to know who all of you are that we're speaking to today, and also for you listening at home or from your office, that you're able to know who your other companions are on the presentation. So we're going to bring up a poll here, and we'd like to know who are you and who are you representing here today in this call. Are you with commercial wind industry? Could be a developer, could be a manufacturer, could be a consultant. Are you in another commercial industry, private industry? Or are you part of a government agency or regulator? Or with an academic or research institution? Or maybe none of the above. So we will take a look and see who we have here on the call.
All right, it looks like that we're about 25% commercial wind industry, about 32% government agency or regulator, 13, 14% academic or researcher, 24% other, and apologies, circling back, about 7% other commercial industry. And I know that didn't add up to 100%, but the numbers are changing in real time on me.
Okay, great. So yeah, clearly a good mix of people across a bunch of different interests and activities. So we'll try and make this applicable for everybody. So my role here today is going to be to walk you through the just kind of the basics of developing a wind farm so that we're all starting from the same understanding. And for those of you that are in the wind industry, maybe this will be really basic, but I think it still bears kind of walking through the fundamentals of how you bring a wind project from a greenfield all the way through to operations. And so I'll hit on some of the key points that I deal with on a day-to-day basis, Invenergy does, and a lot of wind project developers, along with the consultants and industries that support them. So on this slide, I have here kind of some of the big arrows all moving us towards an operational project. We have the prospecting phase at the beginning, permitting and design. Eventually, you would look for offtake for the project and have financing for it, which some of our other speakers will really focus on here today. Constructing the project and then ultimately operating it. So the arrows here are sized a little bit to give you a sense of where typically a project spends most of its time. Prospecting is very important for picking good sites, but usually once you have your site set, then you spend a lot of time in the permitting and design phase. And it can be very cyclical and iterative to ultimately get to the project you want to build. There's then, that you go through a lot of steps, and I'll explain this on the next slide about how you get to that point, but ultimately you would be able to hopefully find offtake for your project, which would mean somebody to buy the electricity from the wind farm. For some developers, that can mean just selling the electricity through various different contractual mechanisms. It could mean also selling the entire asset of the wind farm to an interested party that wants to own it and operate it themselves. In any case, you'll need financing to build the project, the capital to actually do it and bring it to completion. And the construction phase is in there as well. So once you have all of that in place, and again, sometimes these do go out of order depending on kind of your business model, but typically you're going to have financing and offtake in place before you construct. Once you have it completed, then you're going to have to consider all the things about keeping the wind farm running as optimally as possible. Okay, and so this is actually, I've gone through a lot of slides, but this is my last one here, and I want to spend some time on it because there's a lot of information. I think we can really just talk through this piece of it. So to go back to, if you remember the arrows before, the first piece was prospecting. And so if you look on this chart, the pieces here that I would consider the ones to consider for prospecting are probably going to be the ones highlighted in the bold black squares. So there's one over in engineering, and then there's a couple in development. So there can be a lot of factors that go into about why a developer would choose a specific site for a wind project, and really all of these matter. The environmental ones, the engineering ones, the development ones, all matter in terms of picking a good site and prospecting a location where to build a wind project. But I highlight these three because I think they tend to be pretty fundamental to an actual project. You can give and take on all of them to the extent about which they are important, but wind resource assessment, you got to have wind because that's the fuel for your project. Now you can trade that off, and more projects are being developed in lower and lower wind speed areas, as the high wind speed ones are the low hanging fruit that gets picked up first. And you can still have a viable project in a lower resource area, but it's something in prospecting many developers are considering up front. I also mentioned the interconnection agreement. You're going to have a way to sell and transmit your electric power to the load and the demand and to your customer that's buying it. So you need to have the transmission interconnection availability on the grid to be able to move it. And then I also highlighted permitting, local permitting. So special use permit is one name. It comes, that name can be interchangeable and can be said in a few different ways in different places, but basically most of the kind of key permitting that happens for a wind project is usually at a local level. Could be a county level. In some cases, there's state permitting, but that's mostly where it's happening in the United States. And so that is one of the big things, is understanding, is that permitting regime going to be something that works to be able to develop a project there, or are there larger barriers to doing that in some areas over others? So then to go, the whole flow of this is there's a lot of interchange among all of these areas of permitting and design. Environmental engineering development is the way I've broken them up. There's a lot of movement and interconnection between all those pieces, but then ultimately we're all flowing to the right here to go through offtake and financing over to operations. So I'll touch on a few of the pieces in permitting and design because this is really where a lot of the iteration happens. And I should say this whole flow for a project can take, I've seen maybe as short as maybe 2 years, but certainly there's projects that can go longer to that, to 10 or even more years, depending on if the conditions are right for the economics and other permitting aspects for your project. But on the environmental side, which is of key interest for a lot of us on the call here today, there is before you even get into considering a project, there's a lot of bird and bat surveys you will do for most of your projects that can last at least a year in some cases to get all the seasonality, to know what kind of species you have in your area. And how you're going to site your turbines appropriately to account for that. The same is true for endangered and protected species. This can be in the air or on the ground. Sometimes there are burrowing species that would be impacted by your project, and knowing where their habitat is important. Wetland and sensitive areas, so a lot of habitat areas you have to consider, doing hydrology surveys, doing wetland surveys to know where those things are. And then noise and shadow flicker on there. Those are some of the more human environmental impacts from wind turbines. So turbines do make some noise. They are a piece of machinery. So in a particularly really rural area, you have to consider how that impacts the people that are living in and around your project area, and similarly how the blades and the sun passing behind them will, in some cases, well, in all cases, will create shadow flicker, but you have to consider how that shadow will fall. We know the path of the sun, and so we can appropriately site the turbines so that the shadow flicker impact is minimized. On the engineering side, there's a number of studies here: topography, hydrology, geotechnical. All of those are engineering studies, most of them involving field work to understand your site, understand what kind of soil conditions you're dealing with. All of that's going to also feed in with the siting aspects to pick where you're going to put your wind turbines. And a lot of that is based on the other infrastructure, roads, houses, transmission lines, the use of the land, if it's for farming or pasture land, where you're going to put the wind turbines, and also the turbine technology itself. by knowing the resource assessment, by putting up meteorological towers across your site, measure wind speeds, measure how the wind speed changes as you go up in height above ground, and some of the other key characteristics. How turbulent is the wind? How variable is it? All of those things will help you to pick the best machine for your site. And turbine manufacturers are very knowledgeable about their machines and have a variety that can fit into different wind regimes. On the development side, I have a number of different kind of permitting things to consider here. You have to sign up land with your landowners, and they're compensated for leasing their land and being a part of the project. There's often also community benefits that come with having a project and hosting it in your area. The setbacks, that's one of those things, that's what these other big green arrows are for. They feed back into some of the engineering thing. You'll want to decide what's an appropriate setback based on industry guidelines and what works well for that community and that development, about how far turbines and facilities are away from not only each other but existing infrastructure at the site. Wind projects often generate a lot of tax revenue for a community. You have to also consider how the roads and the transport paths that lead to your project will be used, and how they will be maintained through the life of the project and during construction. And I also mentioned the permitting around military activity, aviation, and radar. So some of these things are the, at least with radar and communication, you don't really, we don't see the communications pathways, the microwave links, the radar that's used for monitoring weather, but also guiding air traffic. So those are the kind of things that involve additional technical studies and siting appropriately to make sure that the shared use works for everybody. So finally here, to move over and just take us through to the home here, is that I have the arrow particularly going from special use permitting, because in a lot of cases that local permitting is the thing, is kind of the main trigger that says we have everything set. So much of these other activities all are supporting getting a permit to build a project. But once you have all these things and you can check all these boxes, and you work with being able to market your project and find a buyer, you can move through the offtake and financing. And I'm going to skirt over that a little bit because our other speakers will talk more on the financing aspects. But then it'll take you into construction. That's the more detailed engineering design aspect. So a lot of these things you were doing preliminarily on the left side of the screen are now done in more detail to bring it through construction and actually build it. So electrical collection, your roads, foundations, having a transmission line, a collection substation for all of the cables that are connecting your turbines to go to, and then a connection to get on the grid. And you have to consider, how are we going to operate this in the long term? How do we staff it? These plants won't run on their own. They need to have regular maintenance, people to do that work, and to make sure everything's running efficiently and well. And so that gets into the operations phase. So I focused really heavily on that permitting and design phase, because that's a lot of the iteration and a lot of what takes us through getting us to the construction operations. So that's the big broad stroke overview, and I will pass it off to Natalie from here to talk on our next piece.
Thank you so much, Connor. And Natalie, you should now have a prompt to be able to share your slides.
Okay, let me get my webcam up here. Great, thanks, Pasha. So, with this webinar, we really are trying to focus on not only the economics of wind energy, but how that plays into wind resource assessment, how that plays into financial modeling, and project financing as well, and really looking how we overall assess the viability of projects, and specifically when it comes to environmental minimization, mitigation, and technology. I think to start out here, I'm going to be giving a really high-level overview of energy project financing. It can be very complex, it can be very complicated. I'm going to try and kind of hit the main points. I think if you're really interested in wind project finance, some of the points I've pulled from my presentation come from a really interesting in-roll paper that was put together, and it was wind energy finance in the U.S., current practices and opportunities. So if you're interested, please check out that paper. It's got some really good information in it as well. Let's move forward here. So why do we do project finance? Really over the past 20 years or so, you were really seeing a lot of, companies, utility wind scale projects, they were doing project finance that included equity provided by, the developer itself or the owner operator itself. And I think over the years, development companies are now pursuing much larger, more expensive projects, and that reliance on that type of owner investor equity has really proven to be inadequate. So now there is a need to seek other development capital for these projects. So really over the past decades, you're now seeing the vast majority of wind farms now being funded through project finance. And different companies also kind of have different kind of business models of kind of what they're going after. You often hear of, greenfield developers, that's a company who's really going out. They are, getting the land tied up. They are initiating the permitting. They are putting in their, transmission interconnection queues. There are other companies who like to come in a little bit later, maybe a project that's almost permitted and acquire a project then. Or there are other companies who may be just focusing on acquiring operating assets. And so there are a lot of different kind of models, business models that companies seek out. And so when you're going to get funding for these projects, that really is comprised of three main sources of capital. And that's either sponsor-driven equity, debt, which we a lot of times refer to as construction debt, or tax equity. And so I'm going to go into what those are here in just a minute. But you might also hear some companies who actually fund off balance sheet. And so that is when, if you hear that term, that is when an owner is actually providing all of the financing necessary for that project. And, it could be, really the larger, well-funded companies. Sometimes they may provide the financing on their own. Typically, it's for construction, not for long-term tax equity. So I wanted to just kind of run through some of these. These are kind of common finance terms that you may hear me talk about or others talk about in the presentation. When we're talking about an asset, that basically is the project, the development project or the operating project that the company owns. I touched on balance sheet. Capital, it's really a fancy word for money. Cost of capital, that is really when we're talking about a loan or investment, or in case of loans, that would be the interest rate. Debt, that is the money that is being lent to a company with a timeline for repayment. Typically, we seek debt for construction financing. Equity, that's basically the shareholders' equity or stock. You're also going to hear me talk about an internal rate of return, and this is a really important one. This is basically the metric that a company uses in its financial analysis to estimate the overall profitability of investments. And so, a lot of companies, when we're looking at projects, we need to hit a base environmental rate of return here. Sorry, one second. Okay. And that's important because when we go to our investment committees or our boards to get a project approved, a lot of companies, we need to be able to show that we are hitting that IRR, that internal rate of return, for a project to be able to move forward. Liability, that is something that the company is obligated to pay back in the future, like loans. And then profit is the amount of money that the company is making after you take out all of its expenses. And then revenue, that's the amount of money a company is earning before you take into account expenses. So kind of what are the basics of project financing? And so when we talk about project financing, that's the money that's used to raise capital to build a project or acquire a wind energy facility, and by enhancing sponsor returns and leveraging less expensive targeted sources of capital. And so I kind of mentioned the three components before, where you have sponsor equity. That kind of resembles your kind of traditional equity investor. They could be, sponsor equity could be funded by the original developer of a project. When I talk about construction debt, this is a loan that's kind of taken out that has to be, repaid by the borrower itself. Typically that type of debt is lower risk, low cost, funding. The most common structure for wind facilities kind of these days is tax equity. And so you may hear that a lot. And that is where, wind facilities are getting financed using a tax equity structure, and it's allowing companies to sort of offset their tax liability. And the way that they do that, that's tax equity groups will come in, and they'll provide a lot of upfront capital for a project in exchange for access to, tax credits, tax losses from accelerated depreciation. And typically the tax equity investors come into at COD, and that's our commercial operation. And when they come in, they may often, help pay back some of that construction debt along with sponsor equity as well. In addition, when we bring in a group of tax equity investors, these types of lenders, they also have varying degrees of control over project operating decisions. And so what type of, operating decisions would they have their hand in? So they may need, you may need to go to them for an approved annual budget. And if you're going to go over that budget, you may have to seek a variance. You may also have to go to your tax equity investors if you're going to amend any real estate contracts, or if you're going to enter into a power purchase agreement. And those types of controls that they have are laid out within the respective partnership and financing agreements. So talking a little bit more about project finance and lenders, it's really all about risk shifting. Lenders are not in the business of taking risk. So, when they come in and they're looking at a project, they're going to look at all of these items. They're going to be assessing, what is this project's development risk? What is the likelihood that they're going to be able to obtain all the real property rights? What is their interconnection queue position look like? Are they going to be able to get everything they need in place to move into construction? Once you're in construction, there's construction risk. They're going to be looking, what is the likelihood that this project can actually reach commercial operation without running over budget or behind schedule? They will look at technology risk, look at the turbines, the blades, the nacelles, or transformers, any type of environmental monitoring and mitigation equipment. Is it all going to perform as intended, and has it been tested and proven? I think we'll touch on this a little bit later when we're looking at environmental technology like bat deterrence and, Identiflight. Has this stuff been tested and proven? Overall counterparty risk, they're looking at the project participant that they're doing business in. Are they creditworthy? There's revenue risk, making sure that the counterparty on the off-taker side, does the off-taker actually have the capacity to pay for the power generated over the long-term life of the off-take agreement? And operational risk. We know that wind is an intermittent resource. They're going to be looking, can this project actually achieve the level of performance and power output that we actually forecasted during the development phase, during the engineering and design plans? And there's political risk as well. is the project that's being developed, is there a risk of any governmental action? Is there any risk of denial of discretionary permits? What is their overall environmental liability? And, I think there's also some reputational risk here. I mean, if you're developing a project that looks like it may have a lot of bat fatalities or potentially eagle fatalities, lenders are going to be a little worried about their reputational risk as well. So these are all kind of things that, lenders look at of, shifting risk off of them. And we'll talk a little bit later on how that is actually implemented, in a financial model as well. So in addition, what are kind of some of the project challenges we're seeing today when trying to seek tax equity? It's been kind of a struggle to even find tax equity at all. When we seek out funding for tax equity, this is your bigger financial institutions. These are the ones that are looking to offset a tax liability. So it's your JP Morgans, your Citibanks, some of your more progressives like your Googles or Microsofts, and it's a smaller group that actually understand the structure and have an appetite for it. So I think this year with COVID-19, it's been a little difficult for lenders to really understand the profitability. Do they even have an appetite to offset their tax this year? So it's been a little bit challenging on finding tax equity investment because there are so few. Maybe they've already kind of met their quota and they've offset their taxes. So it's out there, but it can be challenging to find as well. So here a little bit later, I'm going to be kind of talking about how all of this comes together, that all the panelists are going to be talking about, other panelists talking about today. How that kind of plays into real world assessing the viability of a project, within the financial model, hitting your IRR, and making sure that that project actually can be financed and built. So with that, I am going to turn it over to Taylor Parsons at DNV to take us a little bit deeper into kind of wind resource analysis.
Thank you so much, Natalie. And Taylor, you should now have a prompt to share your screen. Perfect.
All right. Thank you. Yeah, so, thank you for giving me the time to present a little bit today. I am Taylor Parsons. I'm a team lead in the energy analysis team at DNVGL. My section as a whole has seen about 75% of the installed capacity of wind projects in the US, and we're a global company, so we have a good amount of experience analyzing the projected energy at a project. I'm going to be talking a little bit about how we do that and how bat curtailment, which is one of the most common ways of mitigating bat risk at a project, plays into things. And then I'm going to hand it off to my colleague Sergio Roldan, who works in the M&A team, to talk a little bit about the financials and how our energy assessment plays into that. So here's an overview of what I'm going to be covering. I'm going to give a quick overview of energy assessment and what it looks like. I'm going to talk about bat curtailment concepts and how projects typically curtail. I'm going to give a case study of operational projects that we've reviewed over the last few years. And then I'm going to hand it off to Sergio, who's going to talk about the financial modeling, the energy revenue, and give sort of an interesting case study and what we can do with that. So here's the why. At the end of the day, my team produces an energy report which projects not just the best estimate of what your project is going to produce, but also a spread of uncertainties in what your project's going to be producing. On the left there, you can see a typical exceedance plot, which is the projection of what your project's going to produce. In this case, we have a project whose best estimate is right over 40 gigawatt hours per year. And the uncertainty distribution describes the combination of the uncertainties in all parts of the assessment. So that takes into account the input data, the quality of the input data, how much data is available to us, what the height of the data is, sort of all the modeling that goes into things. It also takes into account the uncertainties in the loss factors that we apply to our models. So going from the ideal energy production down to the net energy production after all those losses have been applied. Now, curtailment is included in those loss factors, and so that's why I'm focusing in on that a little bit. Interannual variability is another important topic to just touch on really quickly. That's contributing the uncertainties because you don't expect a wind project to produce the same amount every single year. There's variability in the wind resource from year to year, which is an important thing to consider for this audience as well. And that's something that we need to take into account. It's something that lenders typically are pretty sensitive to. And at the end of the day, they're interested in downside cases. What's their risk? They're pretty risk averse. So we need to make the case that if you're more certain in your energy assessment, you typically get better financing terms. So off to the left, I have some vertical lines with p-values. Those are exceedance values. The P50 is the median of your distribution. That's our best estimate. Whereas the P99 represents the value at which 99% of the projected possible production outcomes are being exceeded. So you're going to see a couple terms in Sergio's presentation describing the P99, the P95, the P50. Those are all values that are considered in financial modeling. So how do we get there? In the pre-construction stage, projects have to collect data, wind data at a site for a period of at least a year, up to 5, even 10 years, in order to reduce the uncertainty in your energy assessment. In my team, what we do is we process that data. We remove any erroneous data that we see. We try to extend it to a longer term period using long-term reference data. That's satellite, wind speed, wind direction data, going back as far as 1980 even. We extrapolate that data up to a hub height wind speed in order to sort of get a one-to-one comparison of the relationship between power and wind speed at your hub height. We go through a lot of modeling in order to determine the wind speeds at the turbine locations from the wind speeds that you've measured at your mass locations. And then we do a pretty in-depth energy analysis to get the ideal energy production, apply expected losses factors to that ideal energy production, and then define the uncertainties in every step of the analysis to get that distribution that is then used for determining financing terms. So here's an example of a loss breakdown and a summary of what you might see at a hypothetical 100 megawatt project. This is sort of near the East Coast. We're looking at loss factors, total losses on the order of 22% from that ideal gross energy value. You can see that there are several losses that contribute to that, and down near the bottom there is curtailment. In this case, it contributes less than 1% to the energy loss at your project, and there are other contributors that contribute to the losses much more heavily, things like wakes from one turbine to another, or availability, which is downtime of your turbines for maintenance or other events. You have electrical line losses from your turbine locations to the point of interconnect where you're selling your energy, and other loss factors such as turbine performance, maybe a little bit less performance than expected, or environmental downtime, such as temperature shutdown, something like that. At the end of the day, we give these results to financing parties, and they'll be looking at that P50 net energy, that's our best estimate, as well as several of those uncertainties, the results of those uncertainties at the end of the day. So let's talk a little bit more about back curtailment and what it is. Typically, we look at cut-in wind speeds of that are elevated from the standard cut-in wind speed for your turbine. That means that you're going to be curtailing your turbines or not producing energy when wind speeds are below these certain thresholds that we've shown have lower bat activity during these certain periods. Typical turbine cut-in wind speeds where they're going to start producing energy are 3 meters per second. And so if you're increasing your cut-in wind speed, you can imagine that you're beginning to lose energy that you could otherwise produce. So increasing the cut-in wind speed will also increase the amount of energy that is lost at your project. There are also considerations for high periods of bad activity, such as the month of the year, the hour of your day, and sometimes the temperature, all contributing to, are all based off of your folks' projections of when bats are most at risk. So let's take a look a little bit at what a turbine power curve looks like, and also an idea of what wind speed distributions look like. So the power curve for an example turbine is in light blue there. That's the uncurtailed power curve before changing any cut-in wind speeds. And in gray behind that, those bars there, is a wind speed frequency distribution. That's showing the frequency of the wind speeds in each 1 meter per second bin in this case. With the highest frequency wind speeds right around 9 meters per second. The mean wind speed is relatively high, between 9 and 10 meters per second. And you can see that there are a couple different cut-in scenarios that are being shown here, where you're cutting in, you're starting to produce power at higher wind speeds, at 5 meters per second or at 6.9 meters per second. And this image here can kind of give you an idea of how much energy might be lost because the frequency distribution at those lower wind speeds is going to be pretty highly impacting the energy losses due to that curtailment strategy. Moving into those higher cut-in wind speeds will significantly increase your energy loss. Here's a different frequency distribution where the wind speeds are significantly lower. You have a higher occurrence of lower wind speeds at a site. As was already mentioned, the industry is sort of moving towards lower wind speed regions. So this is a concern on the energy analysis side. There's more lost energy as you have those lower wind speeds, the higher occurrence of lower wind speeds at a project, because you're going to be curtailed more often. So I think we actually have a quiz question to pull up here.
All right, we're going to give it has popped up. We're giving folks a few seconds to answer. Cool. And then I'll let you know what people landed on. All right, well, the answers are still trickling in, but we're in basically a tie, kind of waffling back and forth. 46% have said B, 6 meters per second to 8 meters per second, and 42% have said C, 8 meters per second to 10 meters per second. And then we have a smattering that have gone for A or D.
Sounds great. Yeah, it sounds like most of the audience already knows their stuff. You have a basic concept of sort of the windiness across the US, especially. The correct answer here is about 8 to 10 meters per second in sort of the higher areas of wind development in the area. And as I said, that will play into the magnitude of the losses in certain areas. You know, we're not curtailing for bats in some regions right now, But as we move into those lower wind speed regions, which also might see back curtailment, that's a consideration that we need to take into account pretty early on in the process. All right, so you may have seen this image to the left in the past. This is to give you an idea of the wind speed variation geographically. So winds do vary relatively highly geographically as you move across the US. You can see that there's a lower wind speed region down in the southeast. Wind speeds are relatively high through the Midwest and a little bit in the Northeast. And we're moving offshore, which is really exciting to capture a little bit of those higher winds. But the mean wind speed that's being shown in that map is definitely not everything. To the right, I have 4 different frequency distribution plots. Again, that's wind speed on the x-axis and frequency in the y-axis, with yellow lines depicting a proposed cut-in wind speed of 6.9 meters per second. As you can see, there's a higher frequency in winds below that 6.9 meter per second threshold in several of those frequency distributions, whereas in other cases you have a higher frequency of winds to the right of that distribution, indicating energy that's not going to be curtailed. So something to take into account is that the mean wind speed that you're looking at in these maps may not be everything when you're looking at curtailment. Another source of variation that you can see in energy projects and their curtailment values could be the seasonality in your wind speeds. So wind speeds vary seasonally and by time of day. This is a 12 by 24 showing the 12 months of the year on the vertical and the hours of the day on the horizontal. Highlighted here are maybe a proposed time where you're going to be curtailing your project. And you can see that wind speeds might be lower during those times, also contributing to the assessment of the energy loss at your project. It's worth noting also that power prices can also vary by time of day, which Sergio is also going to cover in a little bit. So all things that kind of wrap into the financial picture of your project and the effects of curtailing your project during those certain periods. Not only does the wind resource vary by time of day and time of year, but also between year to year. So this is especially important for folks like you, potentially who are developing a project. You have a study that studies activity, say for 1 year, maybe 2 years, these short-term periods, whereas in the energy assessment world, we're trying to get down to the long-term energy production of a project, considering as much data as we can. This plot here is showing also that there's that relationship between lower wind resource in green and higher back curtailment losses in blue. So it's important to consider when you're conducting your studies and you're defining your energy losses and other parameters that there is variability in that input data from year to year. You could take that into account as an uncertainty, but variability has more of an impact on, say, your 1-year considerations versus sort of the average smoothed out over a 20-year lifetime of a project. Here's a map showing relative wind resource variability across the United States. It's more qualitative than quantitative. This is based on publicly available satellite imagery, but showing that, and because it's based on publicly available satellite data, that tends to smooth out sort of some of the variability, which is why I don't have numbers in the key here. But illustrating that there are certain regions where variability in the winds are higher than others. You can see that in the southeast, where the wind speeds are lower, there's also lower variability in those already low wind speeds. And you can see higher variability, say near the Texas coast, where there is a high level of development in the industry right now. Best case for a developer is that you have high wind resource. You're going to be able to produce as much energy as you can while also having low wind variability, which reduces the uncertainty in your long-term energy production. So now let's talk a little bit about some case studies to give you an idea of the magnitudes of energy losses related to back curtailment. So in 2008, we saw a study looking at one wind farm, the Castleman Wind Farm, which includes 23 turbines, a study that was conducted from 2008 to 2009 using operational data. And they calculated energy losses due to curtailment to be between 0.3% and 1%, contributing for cut-in wind speeds of 5 meters per second and 6.5 meters per second, and associated that with a reduction in bat fatalities of 44% to 93%. So relatively good results, right? You're losing less than 1% energy and you're reducing bat fatalities, which is great. In 2018, DMVGL did a study to supplement this data from a wider range of projects, considering 15 project years extended through areas where bat curtailment strategies are in place, and considered a range of different bat curtailment strategies with different cut-ins, different times, and different other parameters. The results of that assessment showed a much wider range in bat curtailment values, up to 3.5%. Most of the projects in this data set have cut-in wind speeds of about 5 meters per second. And across the portfolio of all 6 projects, there is a total of 100 gigawatt hours of energy lost due to curtailment estimated. That's equivalent to about $9 million in lost revenue, 8,500 homes powered, or 90 acres of forests to sequester carbon in 1 year. So relatively large impact, much more than that 1% that you might sort of expect as a rule of thumb. So next, I'm going to show sort of a case illustrating the effects of different cut-in wind speeds, as well as in different wind regimes where you have higher or lower wind resource. So as I mentioned, technology advances and cost reductions mean lower wind development sites are being proposed. So if you have a wind site with lower wind speeds at that 7 meter per second average, that's that line there is sort of illustrating the expected incremental annual production loss that you might expect at your project. Again, there are a lot of other factors to take into account, but this is sort of an interesting plot to give you an idea of what losses you might expect at a project. Integrating that with fatality reduction data that we compiled from the industry, you can see data suggests, limited data suggests that there's smaller incremental reductions above 4.5 meters per second about. While also there being incremental energy losses increasing through 7 meters per second. Sort of making the case for if we were to increase the amount of measurements being done at a site and optimize your project for the lowest energy loss due to curtailment, while also reducing the impact on vulnerable bat populations, that would just be fantastic. I think that the industry is moving in the direction of that very problem, which is exciting. All right, finally, here's a summary of what I talked about. So as I said, many factors influence the operational bat curtailment losses at a project. You can decide on different curtailment parameters. You could select different power curves that captured wind resource in different ways. And there's a large variation in wind resource geographically, year to year, etc. Operational data covering 15 project years showed annual production losses of up to 3.5%. I have seen in pre-construction energy assessments already indications that potential losses could be significantly higher, and that makes the case for smarter curtailment. You could reduce the emissions through higher renewable penetration and also save millions of dollars per year, while also reducing the impacts to bats. With that, I'm going to hand it off to Sergio, who's going to talk about how that plays into the financial modeling.
Thanks, Taylor. Hello, everybody. What I'm going to try to do now is to bring all of these concepts down into what this means for either investors and the different players and different stakeholders that are partaking in these projects, and to try to frame it in a way that that we can quantify the impact in revenue to the project. So I want to start by saying, in the beginning there was a financial model. The financial model is what sort of takes in all these inputs from the different speakers that have presented ahead of me. So let me go ahead and what do we think of the financial model as a black box or yellow box? This box will have inputs like the revenue, will have outputs like the cost, and we'll have some output there that I've loosely called earnings. So we can expect that the revenue is the money going into the financial model. This money comes from energy sales, ancillary services, environmental attributes, a variety of features that are part of the wind project. Then things or money going out of the financial model is expenditure, right? What it costs to run the project. So O&M, namely operations and maintenance, G&A, general and administration, other costs such as interconnection, financing, environmental costs, and other non-technical costs. And then finally, the earnings, which is loosely said what the investors take at the end of the day. So as you can see here, the financial model is a tool for the different stakeholders at different stages of the project to evaluate its commercial viability or potential IRR, or just generally speaking, identifying the risks in terms of revenue. So what I want to focus on is specifically on that revenue incoming section of the financial model. And this is covered by the offtake agreement. The offtake agreement is quote unquote the transfer function that allows us to translate the energy estimate in either of the P scenarios, so namely a unit of electricity, watt hour, and allows us to transform it into dollars per year for the calculation of that revenue. Now, the offtake agreement comes in many different flavors. The ones down below there, PPA, corporate PPA, hedge, and proxy revenue swap, they are all varieties of this offtake agreement, and they characterize the risk of the different stakeholders that the different stakeholders take in different aspects. So, for example, the PPA will provide a fixed contract, a fixed price for the exchange of electricity at the point of delivery, whereas the proxy revenue swap will try to offload the windiness risk, namely the risk associated to not there being enough wind, away from the off-taker. So what you should hear from this is that all of these are flavors of the offtake agreement. And one thing one additional flavor is the exposure to merchant pricing. So this is in which the project is exposed to wholesale markets, and there is not a fixed energy rate per megawatt hour fed into the grid. So I want to address this question, right? How does X% drop in energy impact a dollar amount in revenue for these projects, which will allow us to identify whether that 0.5, 0.7, 1.7% drop in energy as a result of backward curtailment, is that a material impact to financials of the project? So I want you to think of the offtake agreement in a scale of, in terms of price risk, where, on the left-hand side here, you would see less price risk to the project. And then on the right-hand side, the project would be more exposed to price risk. And at each end, you will have the PPA on the left and merchant pricing or wholesale market pricing on the right. So how does these two differ? The PPA will have a known, usually fixed rate per megawatt hour put into the grid in a known definite term, whereas the merchant pricing will provide you with variable pricing subject to wholesale market pricing, which is inherently dependent in a variety of factors that go into the transmission system. Now, one characterization that I want to do is that the power purchase agreement as a as a means for revenue to the projects are becoming less common these days. I usually only see them in refinancing of projects where the projects have been operational and have had PPA signed 10 years ago. I think the projects are still using the other flavors of offtake agreements, but within those financial models, there is an assumption that after year 10, 15, or 20 of operations, which is usually when the offtake agreement will expire, the project will transition into these merchant pricing. And in other markets, such as Europe, new ideas are coming up in terms of financing the projects, assuming merchant pricing into the financial model from the beginning of operations. So I want to introduce the easy case, which is the fixed price, and which is what would occur in the case of a PPA. So I have this hypothetical wind farm, 149 megawatts with a 20-year PPA rate of $135 per megawatt hour. A P50 of almost 470 gigawatt hours per annum. So if we think of a potential back curtailment loss applied to that P50 production, anywhere between 0.7 and 1.7%, that would actually translate to nearly or about $400,000 to $1 million per year. Approximately almost 9 to 21.6 million over 6 years. Now, is this a realistic case? Well, it exists. This is actually a wind farm that I've seen, but it's not the norm. And that's because the PPA prices have decreased in the last few days, in the last few years. So this is a slide from Berkeley Lab, and you can see clearly that by region, the price, the PPA price oscillates somewhere between 15, 25, 30 dollars per megawatt hour. One thing to note though is that I'm using this graph shows the PPA execution date. The PPA, as Connor mentioned, often gets executed way ahead of the commercial operations of the project. So I think this is my segue into a trivia time. Pasha, if you could help me facilitate. So the idea being here that we at DNVGL, we take a large portion of the market in terms of reviewing actual PPA rates for projects going COD. So I'm proposing the question is, what's the PPA rate range for the first year of COD observed by DNVGL for 2018 through 2020?
All right, we're going to give folks a few more seconds to vote as I see them coming in. Hang tight, and then I'll let you know what people decide. All right, so about 50% of the people guessed A, 40% guessed B, and 10% went for C.
Ah, that's really interesting. Yeah, the answer is actually B. So it's not as low as I guess you would have expected. So yeah, it's 15.3 to $25.9 per megawatt hour. Okay, so what's the next case? Something that I call the not so easy case, which is structured variable pricing. And this is in the case in which I want to map what you have on the left to what you have on the right. So on the left, you have the forecast in a 12 by 24 of this 100 megawatt wind farm in the US with a 20-year PPA. So this is an actual wind farm, and these are actual rates. So on the left-hand side is the production profile, so namely what percentage of energy is forecast to be produced under that specific window. And then you see on the right-hand side the price, the contract price that the wind farm will receive when that energy, for the amount of energy that is supplied to the grid in that time frame. So you can see that, for the periods where we might consider back curtailment, we can still be affected by the high or upper ends of the PPA rates. And by extension, this is a very similar case to the easy case, just an expansion and increasing granularity on how the pricing is calculated. Now, I want to introduce something that I call the magician's case, which is when we have variable price, and this is in the context of exposing the project to a merchant pricing. So on the left-hand side, we have the same production per year profile in a 12 by 24 format, and then on the right-hand side, we have for November 3rd at 1:30, a map of ERCOT locational marginal price. So that means the price at the point of connection of the wind farm that the wind farm would receive if they were selling in the wholesale market. One thing to note is that this pricing on the right hand side is only valid for that 15-minute period, and then it changes, and it changes according to what's happening elsewhere in the network. And I do want to zoom in into the range that we would look at. So for example, anywhere between $0 to $35 per megawatt hour, depending on where you sit on the network. And hopefully that gives you an idea of the complexity of the case, in that if we are trying to forecast how these prices will change depending on the location of the project, depending on the availability of resource, whether the wind is blowing, the amount of demand that exists in the system, it becomes a very difficult problem to assess. And that's why we want to call the magician. So at InVGL, the way we try to solve this problem is by using this thing called the stochastic engine. It grabs a variety of inputs, weather, wind, load data, and market pricing. It puts it through the stochastic engine and allows and outputs a variety of scenarios that allow us to forecast and create distributions on the different potential impacts of revenue. If you want to think about it more from a Marvel perspective, it's equal to Doctor Strange figuring out all the multiple possible parallel scenarios that could occur given a condition at the beginning of the project. So bringing this down, we actually performed a case study where we looked at a project that is covered by the Midwest Habitat Conservation Plan. The project, we assumed it to be exposed to variable merchant pricing, and we considered two different back curtailment scenarios, one at 5.5 meters per second cut-in and one 6.9 meter per second cut-in. So again, the challenge was to understand what would be the impact of these two different back curtailment strategies, and we used the stochastic model, quote unquote, our magician, to create tens of thousands of years of possible hourly production scenarios, and we were able to produce a range of production and revenue values. So with this in mind, this is what we came up with. So you see the two different curtailment scenarios and the impact that they had on revenue. So for example, in the 6.9, we had an impact in revenue of 1.3% for the P50 case, whereas on the 5.5 meters per second cut-in, the impact was closer to the 0.3% impact on revenue on the P50 case. And the revelation of this sort of highlights and stresses what Taylor was mentioning earlier, that we need to come up with understanding and coming up with understanding the strategies that we're trying to do for back curtailment and quantify their impact. So as takeaways that you should take from my conversation here is that a seemingly small change in energy production can lead to a reduction in revenue for the project in the millions, and that is material, cannot be neglected. The impact of environmental curtailment can be easily assessed for fixed price power purchase agreements, and that can be, there's no real complexity in that. Now, if the project offtake introduces variable pricing, what matters the most from a revenue perspective is when that curtailment occurs and the price during those hours. So again, being able to match the generation and the price available at that time. Now, getting into the more obscure sciencey type of things, the stochastic models allow us for the construction of accurate and realistic production and revenue probability distributions with projects, which will allow us to identify what would be the potential impacts of two different curtailment strategies. And the value out of that is that the different back curtailment regimens can be assessed in the context of a permitting strategy. Namely, should a project take in a higher cut-in and the reduction in revenue, or actually pursue an incidental take permit and just pay the fees for that. So that's what I've got for now. I'll pass it over to Natalie, I think is next.
Great, thank you, Sergio. Okay, let's go ahead and get the rest of this kicked off here. So yeah, I think Taylor and Sergio, really discussed some, complex, complicated aspects of what, we as developers go through to finance a project. And so I'm going to kind of try and bring this all together, layer on some additional points that Taylor and Sergio touched on, give some other examples to kind of really drive the points home. So when lenders are looking to kind of invest in a project, we've talked about this repeatedly. They are not in the business of taking risk. They are going to be providing, significant funding commitments to a project. They have reputational commitments they're going to look out for. So what do they do? How do they make sure that they're making sound investments? So, they will hire a third-party independent engineer. They will hire D&V. They will ask the Sergios and the Taylors to look at the wind resource, look at the financial models to make sure what the assumptions that are making look sound. From the environmental perspective, they'll have a D&V, go through all the environmental work that a project has done. They will be looking, has the project followed the wind energy guidelines? They'll want to see all of the consultation a project has done with federal, state, and local agencies. They want to review all of the on-the-ground field studies that were conducted. They'll be asking us, do we have a burn and back conservation strategy in place? Do you have an eagle conservation plan in place? Are you planning to do any post-construction monitoring? They will ask us, how have you looked at sound issues? How have you looked at shadow flicker assessments? And even more recently, over the years, D&Vs are pushing us as companies to discuss how are we aligned with equator principles. So really looking at a company and a project's social and environmental responsibilities, looking at really deeper stakeholder engagement with not only, agencies, but with the public. They will say, do you have a procedure for a grievance mechanism in place? Do you have a complaint resolution protocol if landowners have concerns they want to bring to somebody? What's that protocol that's in place? And really just looking at overall kind of reporting and transparency of a company. So how does this kind of play into what Sergio was talking about as well when we're talking about, specifically wildlife minimization and the financial model? So project lenders, they don't want to take risk. They want risk shifting. So where do they kind of account for that? So they want to make sure that you are putting very conservative assumptions in your financial model. So, they might ask to see, in the event that a project has eagle risk and may want to seek an eagle take permit, well, you better put those costs in the financial model. And that's kind of hard for developers right now because there's so much uncertainty around eagle take permit program. Are you going to seek a 5-year permit? Are you going to seek a 30-year permit? What are those costs? Is it going to be $3 million or $15 million? So we have to kind of make those assumptions and then walk through the lenders for them to make the judgment on if that's sound for the model. When it comes to, bat curtailment, if you already have an incidental take permit in place or a habitat conservation plan that outlines your bat curtailment, you can plug those into the financial model. I think where it becomes a little bit more challenging is maybe where you're seeing states that just have recommendations. For example, I heard that Montana is looking at putting together recommended guidelines for all wind projects to curtail all night of 5 meters per second in August and September. Well, we may say that's a recommendation, but the lender is going to say, well, it's a recommendation now, but what if it becomes your requirement? You better go ahead and put that in the financial model, or we have to talk to them to really defend on why we don't think the project needs to include that. So how does that affect the overall viability of projects. So, we have to put those costs into the financial model. And when you do that, that outputs and affects the overall investment rate of return, that you have to have a baseline target for a company to be financeable. I know we've heard a lot about, projects when you're looking at that curtailment having a 1% loss, but this really isn't apples to apples. And I really kind of think what Taylor and Sergio touched on is there are a lot of factors that go into that. So what if you have a project where your peak wind resource of the year happens to be during peak that month as well? So that could increase your revenue, your overall losses. What if you have a project with a really high PPA price? So when you layer in, some of these factors, certain projects really could see, revenue losses up over 3%, maybe even hitting 5%. So when you have that in the financial model, that has to be there because the lenders want to be conservative, now you're going to have to offset something else within the model. So now I'm going to have to go back to the turbine vendor maybe and say, gosh, I really need to lower turbine costs, or we really need to find a way to build this project cheaper, or another way you can do it while still finding your main target IRR. Maybe you increase the PPA price a little bit. And the problem with that is, now we're having to increase the PPA price to make up for that lost cost and environmental curtailment. That hurts not only our ability to be competitive within our own industry, but it's really also hurting our ability to be competitive with fossil fuels. So now with that, we have the potential, we may lose a deal to contract or sell power because we weren't able to be competitive enough. So I'm going to set up a poll question here for you guys. Let's take a typical Midwest project. Let's say it's 250 megawatt project, $40 PPA price, let's say 37% net capacity factor. What would be their approximate annual losses and total losses for, let's say, a 20-year PPA project? Annual losses, total 20-year losses, if we're assuming a 6.0 meters per second cut-in speed from August 1st to October 15th. We can launch the responses.
All right, we're going to give everyone maybe a few seconds to keep their votes coming in. Curious to see where everyone lands. All right, Natalie, 10% of the people thought it would be option 1, 56% thought it was option 2, and 34% thought it was option 3.
Okay, well, let's get to it. The answer is option 3. So let's take a look at this. Let's assume our generic 250 megawatt project, let me go back here, 6 meters per second, annual losses are about $900,000, upwards of $18 million for a 20-year term. So here I've taken a look at, you can do a 150 megawatt project, 250 megawatt project, or 600 megawatt project, and look at the range of cut-in speeds all the way from 5 meters per second up to 6.9 meters per second. And you can see the financial losses, the annual gross megawatt hour losses, and really what that equates to annual losses.
Natalie,
and yes.
Sorry to interrupt. We seem to be frozen on the poll, so what I'm going to do is I'm going to unmake you the presenter, and then I'm going to make you the presenter again. Okay. So sorry about this glitch that
no worries.
GoToWebinar is doing. So you should get a new prompt to share your screen.
Okay.
Apologies for that, everyone.
Let me know if it's showing.
It is now. Thank you so much.
Okay, so really quickly, kind of here's the economic impacts ranging from 150 megawatt project, 250 megawatt project, 600 megawatt project, inputting cut-in speeds all the way from 5 to 6.9 meters per second. You can actually see the losses, the annual gross loss production in megawatt hours, and then what are the actual revenue losses yearly a company is facing and what they're facing over a 20-year life. And so what does that actually equate to when we're looking at environmental offsets we'd be losing? So here for a 5.0 cut in speed at 150 megawatt project, if we're curtailing, we are now not able to offset just under 5,000 metric tons of CO2 greenhouse gas emissions. So we are not able to power 828 homes for 1 year. Here's looking at for the 20-year cases from 5.0 to 6.9 meters per second. 6.9 meters per second, that's 600,000, 550,000 metric tons that we're not being able to offset. So, it's hard for us because, this is green energy we're taking off the grid, and we don't want to do that. So what do we want to do? Instead of this blanket curtailment, which really is proving to be too impactful, we've got to, focus in on, smart curtailment is a great option. Being able to just cut in when there is that higher risk. It's important for us to have that temperature threshold. We're not cutting in below 50 degrees Fahrenheit. Really focusing on seasonal components, temporal components, that really, presence and use, curtailing at those specific moments. It'll end up being really kind of helpful for us to remain competitive as an industry and remain competitive against fossil fuels. But ultimately, we do need better siting tools for bats. So what else can we do? It really comes down to technology. I would love to see us be able to find a way for developers or projects to get tax credits for bat deterrence, for eagle detection, even for the ADLS units, which keep the FAA lights off at night. We know that all this technology can be pretty expensive. So, it would be really cool if there could be even a, research and design subsidy to the vendors to help bring down these costs so we could, deploy more of this technology in the field. I think it's, been fantastic that we've been able to see the Wind Wildlife Research Fund come together. Here we're actually investing in the studies. We're using science to find solutions and be able to move away from curtailment and hopefully find these technology solutions that work. And then another important one, just kind of wrap up, we want to keep pushing for research as mitigation. Why do we want to do that? I think when it comes to the financial model, we're having to, let's take Identiflight. If we're having to, in our financial model, already include Eagle take permit costs, the application fee, the monitoring, the power pole retrofits, now we want to put Identiflight on top of that. So that's more costs to add to the financial model, reducing your overall internal rate of return. But if we could get research as mitigation to incorporate that into it, it would be so much easier for us to remain competitive and be more incentivized for developers to be able to deploy this technology in the field. So, pretty complex stuff. A lot goes into all of this, but hopefully we've been able to kind of highlight, some of the challenges that we as developers face when we're developing projects, and how, these inputs into the financial model and wildlife minimization, comes into it. So with that, I think, Pasha, I'm going to turn it back to you. Maybe we have a little bit of time for some questions potentially.
Thanks so much, Natalie. That was fantastic. If we have just a few minutes left, so what I'm going to do is, if folks want to come back onto camera, I'm going to ask one monster smorgasbord combined question from some of the ones we've gotten in, and then I will follow up with you guys over email and get some written answers that we're able to send out to everybody who's here. So my monster combined question for all of you guys is, it seems like there's a lot of aspects of financing that can limit a developer's ability to do research, share data, integrate minimization technology, and implement curtailment. So given that, what recommendations, like if you want to give one final word to the stakeholders in the conservation community or at the federal and state agencies who want to support both wind energy build-out and wildlife impact minimization, what is your burning piece of advice you want to share? So I guess Natalie, we'll start with you.
You know, let's team up. Like, help us find a way that we can convince, you know, the service to do research as mitigation. The only way that we're going to do this, as I touched on, is really, you know, getting this technology deployed in the field. And I think another kind of component to that as well is, if we're going to be doing these studies with Wildlife Research Fund and doing collaborations, you know, we also want to make sure that we have protection against enforcement. That may mean showing more exposure to bat fatalities or eagle fatalities. But the only way that we're going to get better is if we deploy this technology, we test it, we use the science, we improve on it, we third-party validate it, but in a way that, you know, developers are also protected from, you know, fines as well. So.
Awesome. Thank you, Natalie. Sergio, any thoughts?
Yeah, I think that, at least from the perspective of financiers and investors, which is primarily the shareholders and stakeholders that I work with, being able to come up with a business case for those mitigation strategies is a value add. So either understanding a business case for the implementation of technologies to minimize impact, or to help them understand in financial terms what would be the impact of the project in terms of marketing, or all those perhaps not as tangible dollar-to-dollar items that could impact the project, but also the reputation of the investor. So getting that sort of middle ground understanding would be my recommendation.
Awesome. Thanks, Sergio. Connor?
Yeah, I would say those other points, you know, put it pretty well. I think, as was pointed out in some of the presentations, you know, it's about, you know, a lot of what drives the financing is reducing the uncertainty. So I think, you know, the industry has made a big advances in that, you know, even just over the past decade, over the past couple decades, in terms of learning more about all aspects of project development, and wildlife impact included. So yeah, the more we can research and really reduce the uncertainty in those aspects based on actual, you know, science and studies that back up the conclusions, should go a long way to helping to reduce costs, or the cost of energy across all of these projects.
Thanks, Connor. And then Taylor, you get to bring us home.
Sure. Yeah. Yeah. So I think as my other fellow panelists have already described, I think that there's a lot of opportunity for improving the way that we approach things. I'm going to highlight especially the collaborative aspect. I think that this area is one that's really interesting because it combines a lot of different areas of expertise, from the biological aspects to the analysts like me, or the financial folks who end up financing a project. And there is a lot of sort of data out there from one party or another that that people have been using internally that maybe could be used to supplement other people's work. So I think that if there were to be a lot more collaboration between different parties, a lot more sharing of industry knowledge, like through these webinars, but also putting together a plan to improve the research that we do in order to improve the uncertainties and such, we could really go a long way towards all these goals.
Right. Thank you so much, Taylor, and thank you so much to all four of our amazing speakers. And thanks to the audience for sticking with us through a 90-minute webinar on financing. It was super informative. So as I release you to the rest of your day, I just wanted to flag that the final webinar in this series, despite what I said earlier, actually is scheduled, and it will be December 8th from 3 p.m. to 4:30 p.m. Eastern. So after you get a nice break around Thanksgiving, for those in the US who get that off, you can come back and get some like big picture next steps. Again, thank you so much to our speakers. Thank you all for being here, and have a great rest of your day.
Great. Thank you.